What is up, guys and girls, and welcome to DecDoesInvesting, the wealth, investing and finance channel. Before we start, I'd like to ask you to hit the subscribe button to join me on my journey, and also hit the like button to help me out with the YouTube algorithm. In today's video, I have a UK stock that could potentially be undervalued right now and a great buy for growth in the future. In this video, I will give you some background information on the company and then give you some analysis as to why I think it's undervalued. However, I'd like to point out that this video is just for entertainment purposes and should not be taken as financial advice. As always, do your own research before purchasing any stock, as your capital will be at risk. So the stock I'm going to be covering today is Hikma Pharmaceuticals, which has the ticker symbol HIK and is traded on the London Stock Exchange. Hikma Pharmaceuticals was founded in 1978, and if the name doesn't give it away already, it's a pharmaceutical company. The company is focused on developing, manufacturing and marketing a range of both branded and non-branded generic and in-licensed products. The company segments include branded, injectables, generics and others. If we take a look at the one-year chart of Hikma, we can see that it's been on a bit of a bullish run since the correction and reached its 52-week high of £25.75 on May the 28th. Taking a look at shareholder returns, we can see that Hikma Pharmaceuticals over a 5-year period has returned 28.2%, which drastically underperformed its industry average of 84%. However, its returns are over double that of the market, which returned 12.1%. Simply Wall Street and its analysts currently overvalue Hikma by 15.7%, in which they give it a fair value of £19.92, which is calculated on the cash flows the company is expected to generate in the future. But looking at its value a little bit more, we can see it has a PE ratio of 14.4, which is both smaller than its industry average of 17.7 and the market of 14.7, which means there's still good value to be had. If we now look at Hikma Pharmaceuticals' forecasted annual earnings growth, it is expected to decrease by 2.3%, whereas its industry average is expected to grow 20.4% and the market is expected to grow 21.9%. This is also reflected in its forecasted annual revenue growth, in which it's only expected to grow 4.3%, which is greater than the market of 3.6%, but lower than the industry average of 7.8%. Moving on to the past earnings growth analysis of Hikma, we can see that over the past 5 years it fell 9.9%, whereas both the market and the industry grew 13.4%. However, over the past 1 year period, Hikma has redeemed itself, growing its earnings by a whopping 72.3%, which is over double that of its industry average of 36.3%, and smashes the market of 1.9%. Looking at the earnings and revenue growth graph of Hikma Pharmaceuticals, we can see during the period of 2017 to 2018, it skewed its past 5-year performance. In more recent times, for example, 2018 onwards, both its earnings and revenue have increased steadily, with it reporting a profit of $486 million on the 31st of December 2019. Moving on to the financial health of Hikma, we can see that it boasts a strong financial position in which both its short-term liabilities of $1.5 billion and long-term liabilities of $330 million are covered by its short-term assets, which is fantastic. Looking at the financial health of Hikma in a little bit more detail now, we can see that it has a debt-to-equity ratio of 29%, which is very good, and this debt has been reducing over the past 5 years and now stands at $617 million, which is well covered by operational cash flow. Finally, to wrap up Hikma Pharmaceuticals, it currently has a dividend yield of 1.52%, which is considerably lower than its industry average of 3.6% and also lower than the lowest paying 25% dividend paying companies. And this yield is only forecasted to grow to 1.7% in the next 3 years. Moving on to the growth and stability of this dividend, we can see that it currently pays a dividend of 44 cents per share, which has been paid and also grown over the past 10 years, which is great for its dividend growth investors. And finally, looking at how well this dividend is covered and the safety of it, we can see that Hikma Pharmaceuticals currently has a payout ratio of 22%, which is forecasted to grow to 30% over the next 3 years. This is a fantastic payout ratio that not only leaves enough money for the dividends to be paid, but there's still plenty of room for this dividend to be grown. So that wraps up this video on Hikma Pharmaceuticals. So leave a message down below if you plan on buying Hikma or already own Hikma. And if you've liked this video, please drop it a like. Subscribe if you want to see more videos like this, and if you've missed any previous videos, there will be a link to the playlist in the description down below, along with some other videos that may be of interest. And until next time, peace.